Chapter 23 will be about evaluating variances from standard costs. So let's just look at these words. The word variances means how did our answer vary from what we expected? And then the word standard in this sense, and you're going to hear us talk a lot about standards in here, is just what we expected. We're going to come up with a standard cost that is based on our best estimate, and then we're going to compare it to actual, and that will get our variance. Accounting systems that use standards for product cost are called standard cost systems. And this just means we're going to determine how much a product should cost, that's your standard cost, and compare it to the actual cost. Any difference in what it should cost and the actual are going to be called our variances. When actual costs are compared with standard costs, the exception or variances are reported. So because we're only looking at exceptions, that is things that differed, we are going to call this management by exception. And that is, again, if what we actually got is the same as what we thought we get, we don't look at that item. We're only going to be looking at the items that had a variance. This is called management by exception. An important part of this is setting the standards. That is, deciding how much it should cost. We're going to need help from management, engineers, accountants, to do that. Engineers may know what the type and quantity of material we need is. Then the accountant will convert the results of judgments and process studies into dollars and cents. There are two types of standards. First, we have ideal standards. These are theoretical standards that can be achieved only under perfect operating conditions, such as no idle time, no machine breakdowns, and no material spoilage. Such standards may have a negative impact on performance because they may be viewed by employees as unrealistic. The second type of standard is normal standards, or sometimes called currently attainable standards. These are standards that can be attained with reasonable effort. Such standards, which are used by most companies, allow for normal production difficulties and mistakes. So we are all human and we make mistakes, and those normal mistakes are built into this kind of standard called normal standards or currently attainable standards. So when reasonable standards are used, employees focus more on cost and are more likely to put forth their best efforts because they don't feel like that what they're being asked to do is unreasonable or impossible. Once you finish setting your standards, you should have to periodically review those standards. Standards should not be revised just because they differ from actual costs, but you should revise them when prices, product designs, labor rates, or manufacturing methods change. That's when you should review and revise. You should always review, but you should revise it when one of these fundamental changes happen. Some people don't think that standards are a good thing to use. This slide shows some of the criticism of standard cost. For example, some employees may not try to do better than the standard. They may just look at the standard, and if they meet it, that's as good as they try to do. Standards limit operating improvements by discouraging improvement beyond the standard. Standards are too difficult to maintain in a dynamic manufacturing environment, resulting in stale standards. So if the manufacturing environment is constantly changing, it may take too much work to update the standards as quickly and as often as things are changing. And this would result in stale standards, standards that were good for yesterday but not good for today. Standards can cause employees to lose sight of the larger objective of the organization by focusing only on efficiency improvements, because maybe they focus only on efficiency improvements and don't look beyond these, so it can cause them to hyper focus on these standards and possibly harm other operations that rely on them, because they're only looking at it in kind of like a tunnel vision. They're only looking at those standards. That's the only thing they're using to evaluate themselves. So the budgetary performance evaluation compares the actual performance against the budget, just like we've done in previous chapters. So we have Western Rotter, the manufacturer of blue jeans, and they use standard costs in the budget. The standards for direct material, direct labor, and factory overhead are separated into the following two components: standard price and standard quantity. And this is what we're going to be using for the entire chapter. Notice the first one is price and then the next one is quantity. When looked at together, that is your total of any one item. So the standard cost per unit for direct materials, direct labor, and factory overhead is computed as follows. And it's made up of price and quantity. And if we multiply that together, we get the total. So we're going to be doing these standards for direct material, direct labor, and factory overhead in this chapter. For all the problems, we'll need to be given the information. In this example, for the manufacturing of blue jeans, we've got direct materials, and the standard price is $5 per square yard, and it typically takes, that's the standard quantity of 1.5 square yards. So when we multiply it, we can find the standard cost per unit of the extra large jeans, $7.50. We can do the same thing for direct labor and for factory overhead. When we add direct materials, direct labor, and factory overhead together, we can get $19.50. This is similar to what we've seen in the previous chapters. We're going to have a master budget prepared based on planned sales and production. You're going to have the budgeted costs for material purchases, direct labor, and factory overhead. And they're going to be determined by multiplying the standard cost per unit by the planned level of production. And then budgeted costs are then compared to actual costs during the year for control purposes. So the direct materials price per square yard is controlled by the purchasing department, and the direct materials quantity per unit is controlled by the production department. If we spend less than what we had planned for our standard, it will be called a favorable cost variance. If we spend more than what we planned, it will be called an unfavorable cost variance. So the definition of favorable cost variance occurs when the actual cost is less than the standard cost, and unfavorable cost variance occurs when the actual cost exceeds the standard cost. Here it is in a graphic form. Favorable cost variance is when actual cost is less than standard cost at actual volumes, and then unfavorable cost variance is when actual cost is greater than standard cost at actual volumes. Notice they put in at actual volumes. So we used actual volumes, we flex it up to actual volumes to figure out these cost variances. So the report we're going to use to summarize this information is called the Budget Performance Report. Remember, it's based on actual production rather than planned production. So it's flexed up to actual production. So we actually produced and sold 5,000 units, and the direct material actually incurred was 40,150. Direct labor was actually 38,500, and factory overhead was actually 22,400. So when we put it into our report, okay, so we're going to look at it and we're going to compare it to actual. These were the numbers that were just given to us. And then we're going to multiply to get our, here they are down here, we're going to multiply to get our standard cost at actual volume, which was 5,000, times our standard cost down here. So everything is 5,000 because that was the actual we produced, times our standard cost. Then we're going to have these numbers right here. And that's when we'll compare it to our actual. See, here was the actual, and here's where the actual is. So direct materials actually cost $40,150, but we expect it to cost $37,500, so that is unfavorable. Look at factory overhead. It costs $22,400, but we thought it would cost us $24,000, so that is favorable. So when you net the unfavorable to with the favorable, we had an unfavorable difference of $35.50 variance. So we looked at the total manufacturing cost variance, but for control purposes, for example, to look at the differences and really be able to make decisions based on these differences, we're going to break or separate each cost variance into two additional variances. So we're going to break it down into price and quantity variance, because each of these variances was made up of price and quantity. Sometimes the price we paid was higher than we expected, but sometimes we used more quantity than we expected. So the net of the two together gave us our total variance. Now we're going to separate it into price and quantity variance. So that way we can see what really happened. So this is going to give managers much more information to look at the variances and really make decisions. For example, if they're paying more than what they expected, then maybe they need to renegotiate or look at why. If they're using extra quantity, then maybe they need to look and see if there's too many errors or if the machine is messing up or what's happening and why they're using more quantity. So breaking it down into these two variances is going to give management a lot more information. To look at the price difference, you look at the actual price minus the standard price, and to look at the quantity difference, you look at the actual quantity minus the standard quantity.